Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. GAAP concepts and assumptions. GAAP stands for Generally Accepted Accounting Principles, which are the rules and standards that guide how financial statements are prepared and presented in the United States. GAAP is based on some key concepts and assumptions that underlie the accounting process. Some of these are: economic entity assumption. This means that the business is treated as a separate entity from its owners and other businesses, and its transactions are recorded separately from the personal transactions of the owners. Monetary unit assumption. This means that only transactions that can be expressed in terms of money are recorded in the accounting records. The monetary unit is assumed to be stable and not affected by inflation or other changes in purchasing power. Time period assumption. This means that the life of the business is divided into artificial time periods, such as months, quarters, or years, and financial statements are prepared for each period. The time period assumption allows for periodic measurement of performance and financial position. Going concern assumption. This means that the business is expected to continue operating indefinitely, unless there is evidence to the contrary. The going concern assumption implies that assets are valued at their historical cost or lower, and liabilities are not discounted to their present value. Accrual basis of accounting. This means that revenues are recognized when they are earned, and expenses are recognized when they are incurred, regardless of when cash is received or paid. The accrual basis of accounting matches revenues and expenses to the periods in which they occur, and reflects the economic substance of transactions rather than their cash flows. Revenue recognition principle. This means that revenue is recognized when it is realized or realizable and earned. Revenue is realized when goods or services are exchanged for cash or claims to cash. Revenue is realizable when assets received in exchange are readily convertible to cash or claims to cash. Revenue is earned when the business has substantially performed its obligations to the customer. Expense recognition principle. This means that expenses are recognized in the same period as the revenues they help generate, following the matching principle. Alternatively, expenses are recognized in the period they are incurred, following the cause and effect principle. Some expenses, such as depreciation and amortization, are allocated to periods based on systematic and rational methods, following the systematic and rational allocation principle. Cost principle. This means that assets are recorded at their historical cost, which is the amount paid or obligated to pay to acquire them. Historical cost is objective and verifiable, and provides a reliable basis for measuring financial position. However, historical cost may not reflect the current market value or economic usefulness of an asset. Full disclosure principle. This means that financial statements should provide information that is relevant, reliable, comparable, and consistent, and that any material information that could affect the user's decisions should be disclosed in the financial statements or the notes to the financial statements. Full disclosure enhances the transparency and credibility of financial reporting. Historical cost. Historical cost is a concept in accounting that refers to the original or acquisition cost of an asset. It is based on the assumption that the value of an asset is determined by the amount of money or resources that were spent to acquire it, rather than by its current market value or replacement cost. Historical cost is often used to measure the value of fixed assets, such as property, plant, and equipment, because it is objective and verifiable. However, historical cost has some limitations as well. For example, it does not reflect the effects of inflation, depreciation, or obsolescence on the value of an asset over time. It also does not capture the opportunity cost of using an asset for a specific purpose, rather than for an alternative use. Therefore, historical cost may not always provide a reliable or relevant measure of an asset's true economic value. Materiality. Materiality is a concept that refers to how important or significant something is in a given context. For example, in accounting, materiality is used to determine whether an error or omission in the financial statements would affect the decisions of the users of those statements. In art, materiality is used to describe the physical properties and qualities of the materials used by the artists, such as texture, color, shape, and size. Materiality can also be related to other fields, such as philosophy, sociology, and ethics, where it can imply different meanings and implications. Materiality is not a fixed or objective attribute, but rather a relative and subjective one that depends on the perspective and purpose of the observer.